U.S. stocks have dropped sharply after new concerns over Germany's Deutsche Bank.
Investors continue to worry about the health of the global banking system.
Banking is a nightmare. They can cause a lot of carnage when things go wrong.
We have just witnessed the largest banking bailout since the great financial crisis, with the new plan that would provide infinite fundings to banks. In this video, I'm going to talk about how you protect yourself against the mismanagement of the big banks and be prepared for the potential worst. So before we go there, how does this all happen? It really all happened since March 2020, where the banks has drastically reduced the interest rate to nearly zero just to stimulate the economy so that we will not have a recession, because the government has drastically increased the interest rate 7 times over the last 1 year, which is the fastest in the history. With all the interest rate hike, why Silicon Valley Bank is the first one to fail, but more banks might be collapsing as well? Because of the dropping in interest rate, Silicon Valley Bank has been getting a lot of 0% interest loan. That sounds really good, right? Since June 2020, Silicon Valley Bank has a saving of $76 billion. But fast forwarding a year from that, 2021 December, the Silicon Valley Bank has $191 billion in saving. Still sounds really good to this point, right? But it's the saving for the customer. But the banks need to find a way to generate interest so that they can pay a return to the investor. Now, the problem is that the tech companies in Silicon Valley who traditionally borrow money from SVB did not grow at the same speed as the saving rate grew at SVB. So that means that SVB has to go find other ways to generate the interest. So at that time, SVB was looking at buying government bond that give them the return of 1%, but expires between 1 to 5 years. And as we all know, after the rate hike, the US bank are paying investor for their deposit around 3, 4, or even 5%. So if the SVB bank is only getting 1% from the government bond and they need to pay, let's say, at 4%, they're negative 3%. This is all unrealized until they start selling all the bonds. But if you look back in the history, it's not such a good decision because bonds yields are low and you're stuck in the investment for a very long time. And what caused SVB the biggest trouble is because the bonds they bought are held to maturity investments. If you withdraw earlier, not only do you lose the interest that's supposed to be generated, you also can lose a portion of your principal. And this is totally different from the savings you put in your savings account, right? Worst case, if you lock your savings account for 1 year, if you have to withdraw earlier, that just means that you won't get paid as much of the interest, but you won't lose your principal. And this risk is called short-term financing for long-term investment. And most of the banks do run into this situation regularly. Imagine you put $100 in the bank, the next day you can go withdraw that $100. But if you get a mortgage from the bank, doesn't mean that the bank can get the loan back from you the next day. Usually it takes about 5, 10, even 20 years. So you're probably thinking, Cody, so if this happened to the banks regularly, why is it so different this time? Remember I said it's all unrealized losses until SVB banks sold all their bonds. So SVB banks went and sold 21 billion of their 5-year government bond and took a loss of $1.8 billion. And that's when all the investors with SVB realized that there could be something going on and they start to panic and wants to get more of their money back. On March the 8th, 2023, the withdrawal request from an investor was 42 billion. But SVB Bank only has 10 billion cash at the time. So what does that mean? SVB Bank easily just claimed bankrupt.
I declare bankruptcy!
What can you do about this to make sure you're protected? So if you're in Canada, you are protected by CDIC. The CDIC protects eligible deposits and Canadians of foreign currency for up to $100,000 Canadian. This protection applies to deposit held and registered accounts such as RSPs and TFSAs, and non-registered accounts such as saving, checking, and joint accounts. Most of you guys are watching this video from the US, And in US, you're protected by FDIC. FDIC is an insured account, is a bank account at the institution where the deposit is federally protected against bank failure or theft. The FDIC is a federally backed deposit insurance agency. The maximum insurable amount is currently $250,000 per depositor per bank. So this is how it affects you and my personal thoughts on this matter. There is no bank that's too big to fail and just hope that yours won't. When the interest rate are dropped during COVID substantially and then drastically hike a year or two later, that can cause even the banks to get out of control. Now, what does that have to do with us? There's really no need to panic. If we cut down our spending and not over leverage on your loans and make sure you can service the loans if there is a higher interest rate. The truth is that when the US sneezes, the entire world will catch a cold. And most likely, if another bank were to fail, feds will come in and rescue that bank just to prevent the domino effect like 2008. So if you're worried about leaving your money in the banks and you want to generate more than 4 to 5%, check out the links in the description about my said and done strategy. It will help you generate 18 to 54% per year. And with that being said, thanks for watching and don't forget to subscribe and like this video and put down any comments of what you think about this situation. Say yay.